Over $1 billion just vanished from Bitcoin ETFs in a single week. But, the smartest money in the room, they aren't panicking at all.
Right, they're rotating.
Exactly. So, welcome to today's deep dive. We're looking at market intel from May 25th and 26th, 2026. And the mission today is to track this massive institutional capital shift happening right beneath the surface of the market's current narrow consolidation.
Yeah, because the surface level price action is pretty boring right now, but underneath there's this incredible behavioral split.
Okay, so let's unpack this. Think of it like this. Right now, traditional fiduciaries, they're treating Bitcoin like a slow-moving macroeconomic savings account.
Yep, a massive savings account.
But at the exact same time, they're treating application layer tokens, like decentralized exchanges, as, high-growth, early-stage tech stocks.
I mean, it's a savings account that just saw a $1.315 billion withdrawal in a single week, which is huge.
Wow.
But to actually understand why that capital fled the ETF so fast, we have to look at the macro picture, specifically the Strait of Hormuz. Because the U.S. and Israeli kinetic strikes on Iranian naval vessels there just changed the entire math.
Right, because that strait handles, roughly 20% of global oil flows?
Yeah.
So you're suddenly putting a massive chunk of the world's energy supply at extreme risk.
Exactly, which basically guarantees sticky supply-side inflation. Energy goes up. Well, everything goes up.
Oh, sure.
And that completely paralyzes the Federal Reserve. They just can't cut rates. So if you're a Wall Street fiduciary, algorithmic models mechanically force you out of zero-yield assets like Bitcoin. The ETF money didn't vanish because of crypto fundamentals. It vanished because of a macro spreadsheet.
Wait, hold on, though. If institutional money is fleeing the primary asset at that kind of scale, isn't the entire digital asset ecosystem fundamentally vulnerable right now?
Well, what's fascinating here is that the capital isn't really abandoning the sector. It's actively rotating.
Oh, really? Moving down the stack.
Exactly. Sophisticated allocators are moving into revenue-generating decentralized infrastructure. Like, look at Hyperliquid. They just absorbed $72.3 million in institutional inflows.
Just to build out their canonical prediction markets, right?
Yeah, canonical prediction markets. Usually these markets rely on external data oracles, third-party data feeds, to tell the blockchain who won a game or an election.
But Hyperliquid internalized that, right? They use their own native network validators to autonomously publish markets and vote on real-world outcomes.
Exactly. It removes that third-party friction, which drastically speeds up execution. And that frictionless architecture is exactly what's pulling in that rotating institutional capital.
See, here is where it gets really interesting to me. You have this brilliant, trustless on-chain architecture, but it immediately slams into real-world borders.
The regulatory pushback.
Right. Like Spain just preemptively banned prediction markets like Polymarket and Kalshi. They aren't treating these event contracts as sophisticated hedging tools. They're classifying them straight up as illegal, unlicensed gambling.
Which is a huge jurisdictional hurdle. So the application layer is catching serious regulatory heat in Europe.
Exactly. So the big question is, can sophisticated decentralized infrastructure truly outrun legacy statutory monopolies? Or does it just suffer death by 1,000 jurisdictional cuts?
Well, if we connect this to the bigger picture, it explains the market divergence perfectly. Because while the app layer fights regulators and Wall Street panic sells ETFs on macro news, corporate treasuries are quietly executing relentless accumulation of the base layer.
Oh, the corporate diamond hands.
Yeah. Strive just scooped up another 11,109 Bitcoin.
Pushing them to, 16,500 total.
Yep. And then you have Hyperscale Data growing its treasury to nearly 700 Bitcoin.
And they're doing that using high-margin AI colocation facilities to fund their purchases, right?
Right.
Generating fiat cash flow to organically buy more protocol.
Exactly. It really highlights how different players view the asset right now. Wall Street views it as a highly liquid risk proxy. They dump it the second geopolitical friction spikes.
Right, but corporate operators view the protocol as permanent financial bedrock.
Precisely. They're just treating it completely differently.
So, what does this all mean for you listening? The ecosystem is rapidly maturing, and it's splitting into these very distinct behavioral buckets.
Yeah, on one side you have macro duration proxies for corporations, and on the other, revenue-generating decentralized infra.
Right, but that leaves us with a pretty intense structural tension to think about.
It does, which raises an important question to leave on.
Yeah. If sovereign nations continue to legally classify decentralized prediction algorithms as illicit sportsbooks, how will a supposedly borderless, unified global liquidity pool actually survive state-by-state legal attrition. It's something to really keep an eye on.